My name is Dak Hartzog. I'm a nationally cited investment expert and your presenter today. And the reason I decided to do this video through wealth education seminars is because I really enjoy helping people understand how the financial industry actually works. And in most cases, it is an eye opener for people and very different from what they were expecting. In this short video, I will show you the reality behind some of the Wall Street myths that you've heard over and over from stockbrokers, from financial advisors, annuity salespeople, and even the financial media. And I will show you how believing these myths creates serious disadvantages for investors like you. This video will show you why the most successful investors choose to step outside the Wall Street system and also how they do that. And I know this sounds a little like a conspiracy theory, but bear with me for a few minutes and you're going to see that it really isn't a conspiracy. It's just a system that is built to extract money for the benefit of the largest players in the industry. And by the end of this video, it's going to be very clear to you that that money is coming from your pockets. So what is the Wall Street system? And why do the most successful investors avoid it? Simply put, the Wall Street system is a group of companies and people that profit from your money, whether or not you financially benefit from working with them. They feed off investors and they help feed each other. According to eMarketer, the financial industry will spend nearly $12 billion on advertising, online, TV, digital advertising, and another about $5 billion in traditional advertising. That's $54 for every man, woman, and child in the United States. Why spend such huge dollars on advertising? Well, first, they need to appeal to investors because they need to sell products to the investors, and the reason they do that is because these products make everybody a hell of a lot of money. And this whole system is all around us. It's in TV, it's in newspapers, magazines, it's on the web. And you may recognize some of these names, some of these shows: Mad Money, Squawk Box, Fast Money. These shows make money by selling advertising, but there's no actual benefit to the investors from watching TV. It's they're just really reality shows that pretend to give advice and know something that you don't, but really they're creating excitement because they want to bring in the advertising dollars from financial product companies, big brokers, banks, mutual funds, insurance companies. These are the firms that pay for this advertising, and that's okay. You know, they're advertising because they want to bring in business, and that's fine. The problem is that these shows and some of these magazines, they're not accountable. They're not accountable for the content. They're not accountable for their advice. There's nothing that comes up when someone is talking on CNBC or Fox or Bloomberg or whatever that says, you know, this guy or this gal has been on 12 times in the past and has made 15 calls about buying or selling, and X percent were right and X percent were disasters. And the reason they don't do that is because they're not there to give investment advice. They're there to create interest, they're there to create excitement, they're there to create activity, they're there to sell advertising. And shows and magazines and things like that that don't help the industry are not able to get advertisers, and they don't last. And the same goes, you know, for the financial magazines like Barron's and things like that. And by the way, if anybody watching this video has actually gotten rich from watching TV or, you know, reading Barron's, I'd love to hear from you. It'd be a great story because you'd be the very first. I mean, talk about bucking the odds. Anyway, the way these companies engage you is through financial salespeople. And you need to be clear on the fact that these people work for the brokers or the banks or the insurance companies. They do not have your interests at heart. They call themselves financial planners or financial advisors, but in reality, they're salespeople. They live off commission. If they don't have a commission coming in, they don't have commissions coming in, they can't keep their jobs. So you need to be aware of that. It's also a little known fact outside the industry that anyone can call themselves a financial advisor. So just because you're dealing with someone that says, I'm a financial advisor, that's a meaningless title. Your 10-year-old daughter can go out tonight and decide to call herself a financial advisor, and the SEC is not going to stop her. And the state financial regulators are not going to stop her because you can do it. It's not regulated. Anybody can call themselves a financial advisor because financial advisors are really just salespeople. And that's part of the issue that the Obama administration has had that you may have seen in the media with some of the ways the industry works. It's not clear to most people that these financial salespeople and some of these companies, they only exist because they're getting your money. This is the poster boy of the Wall Street myths, and the advertising and the machine. This is Jim Cramer. For those of you that don't know him, he's very successful media personality. It's a little known fact that he's actually a former hedge fund manager. Some of you that do know who he is might not know that he was a former hedge fund manager. Those of you that do know he was a hedge fund manager probably don't know that he lost 95% of his clients' money in the dot-com crash. So here it is, the cover of his book. It says, "Watch TV, get rich." It's not that easy. If it was, he'd still be a hedge fund manager. But he's not. And he makes his money from advertisers. And you can guess who they are. And if you don't want to guess, you can just watch the show and pay attention to the ads. He's paid for creating the exciting content, the transactions and the activity that Wall Street loves. And he does that by advising people to buy and sell stocks based on the flavor of the day. The problem is that virtually all market-made billionaires, along with independent research firms like Dalbar Associates, have identified frequent trading as a top reason individual investors underperform. So that's something you need to be aware of. And we can clearly see this because Dalbar did another study that, based on this idea that you can buy this particular investment or watch the show or read this book and suddenly you're going to know how to handle things. Here it is. Here's 20 years of returns. The S&P 500 did just under 12%. Inflation's running at 3%. But the average investor only managed to eke out a 3.7% return, barely above inflation. That's the average investor. So that means that about half of people did worse than that. And that's kind of scary if you think about it. So myth number 2, stay the course. The market will be fine over the long term. You've heard this from brokers, I'm sure. So let's take a look at the numbers and see what's really going on here. What you see here in this chart is 120 years of returns. And you can see that most of the market's gains came in 4 out of those 12 decades, and the majority of those actually happened between 1980 and 1999. It should also be pretty clear by looking at this chart that you could go 5, 10, 20 years without seeing a meaningful gain if all you did was buy and hold. Just as often, not only did you not make any money, you didn't even keep up with inflation. And for those of you that aren't sure what inflation is or how it can affect your investment account, what inflation does is it destroys purchasing power over time. So let me give you a simple analogy. Let's pretend it's January 2000 and you've got $1. You thought you'd like to buy a hamburger, but you decided to invest it instead. And let's say you kept your dollar in the stock market until 2010, and then you told your broker, you know what, I want to buy that hamburger that I gave up in 2000 so that I could put the money with you, and I need $1 from my account in order to buy that hamburger. Well, guess what? You'd have to take out about $1.33 to buy the same hamburger that cost you $1 10 years before. And why is that? The market didn't return anything for your dollar in that period, but inflation did what inflation does, and that's erode your purchasing power. And just as a side note, inflation is your biggest enemy in retirement by far. Myth 3, go out, put your money in a professionally managed fund, mutual fund or whatever, and just sit back, your money's going to grow. Well, in 1970, there were about 355 stock or equity mutual funds. By 2000, most of them had gone out of business. The ones that remained couldn't keep up with their benchmark, and so you understand what a benchmark is. It's like the S&P 500 is a benchmark that a lot of companies or funds use in order to weigh their performance. So, what this is saying is you would have been better off just buying the S&P 500 and not touching it and staying away from it than buying any of these funds. And this data is provided by the Bogle Financial Markets Research Center. It's founded by John Bogle, who also founded Vanguard Funds. And the results are not encouraging, and it's a great reason to think carefully before you invest your money or allow someone else to invest your money in mutual funds. And there's more that's even more alarming about that. According to the Investment Company Institute, 55% of all mutual funds sold are sold by financial advisors or brokers. Right now, there's about 7,700 mutual funds out there. And out of those 7,700 funds, 47% carry a front end sales load of 4% or more. So, to give you an idea what that actually means, let's say you've got $1,000,000, your advisor or your broker says, well, I want to put it into this mutual fund. It's a good place for it. Chances are, 1 out of 2 chance, that mutual fund has got a sales load of 4% or more. So that means out of your $1,000,000, you just paid a $40,000 commission. And it gets worse. 61%, 6 out of 10 out of these mutual funds carry a deferred sales charge that's in excess of 1%. So what that means is when you rebalance your portfolio, or when your advisor calls and says it's time to rebalance, not only are you probably going to be put into another mutual fund with that 4% or more load, but you're going to pay another 1% to get out of the one that you just bought a couple of years ago. So now your $40,000 that was taken out of your $1,000,000 account is now $50,000. But wait, there's more. 90% of mutual funds have management fees in excess of 1.5%. And that's usually in addition to any of the sales loads, including the deferred sales charge. So now we're in the $65,000 range. On top of that, if you've got a wealth manager that is putting you into these load mutual funds, there's a very good probability that that person is also charging a management fee on top of everything else. So management fees usually run for brokers or advisors between maybe about 1%. They could be 1.5%, 2%, even 2.5% or 3% in some cases. For a $1,000,000 account, probably around 1%. But the point here is, if you happen to have the kind of person or lack the knowledge, and your money is going into one of these accounts that has, or a mutual fund that's got a 4% or more sales load, a 1% deferred sales charge, a 1.5% management fee at the fund, and a 1% fee from your broker, that's $75,000 out of your million that's gone. Think about what that $75,000 could do for you or your family if invested at 6% without these fees, or 4% or 7% or whatever it is, over a 10, 15, 20-year period. I think that should probably make it pretty clear that you're leaving a lot of your money on the table and your family's money on the table when you're buying these kind of products and you're accepting these kind of solutions. And the conclusion that I draw from these studies is that the majority of financial advisors and brokers sell mutual funds to their clients because that's the business. And it's where they earn their commissions. It's how they keep their jobs. It's how they pay for their houses, their cars, the private schools for their kids. But the problem is the majority of those clients that are put into these kind of products, mutual funds, end up underperforming the broad markets. So myth 4, this product is going to solve your problems. We've already talked about mutual funds. There's the statistic right there in the right-hand corner. Let's talk about some of the other products now. And when you're thinking about these things, you need to remember that the industry needs products to sell. And when people try to sell you these products, ask yourself what's in it for them. It's a commission. And they say, oh, you're not going to see it. Yeah, I get a commission. You're not going to see it. It's not enough to affect the account. Don't be fooled. And let me give you an example of this. Recently, I dealt with a senior executive at a national food company, and he had a nice 401k. He was doing all right for himself, young 50-something. And he had about $600,000 in his 401k. And you would think that, he's a senior executive in the company and he's going to have a pretty good 401k plan. The problem is when we dug into it, we found out that he was paying about $17,000 in annual fees. Just on his 401k, he wasn't even aware they were there. So that just gives you an example of how this could work, because he was in mutual funds and things like that. At any rate, to return to some of these products, a variable annuity is very expensive. You get basically 6% upfront charges, and that's on top of a 3.5% management fee that is basically charged every year. And that 3.5% is for sub accounts. That's just a fancy word for they're putting your money into different mutual funds. And then you get another, say 0.5% or 1.5% for guarantees on the fund, and that's 85% of people never use those. So, pardon me. So basically, you can lose money when your account earns less than 6% or 3.5% or whatever it is, and the guarantees that they're charging for that you add on, it's basically fake money. It's not anything that you're ever really gonna get or that you're gonna be able to use. Mutual funds we've already talked about a little bit. They average close to 5.5% when you're talking about the upfront charges, the deferred sales charges, the management fees. Most people own mutual funds and they're familiar with them, but they come in a really confusing array. 7,700 funds available today. You get the ones that have the sales loads, you've got the ones that have no loads, you have A class shares, B class shares, C class shares. Most people can't begin to make sense of this. And actually, they don't. They just take the word of the guy that's selling it to them. REITs, for those of you that don't know, are real estate investment trusts. And these things are really popular among brokers and financial advisors. And they sell these things using the dividend diversification angle, but many pay people that sell them 8% or more commission. And then they take a management fee on top of that, but they aren't managing anything. The REIT's managing it. Most of these are non-traded products. So what that means is there's no liquidity. So if you need to sell because Susie needs braces or you didn't get your bonus, so you need to take some money out of your account to pay for your son to go to a couple semesters of college, you might have a really hard time getting that money back out. So if you're going to be put into what's called a non-traded REIT, you better find out how long it's going to take you to get your money out. Index annuities have big commissions. They can be 6%, 7%, 11%. The mean commission's about 9%, but you need to realize there's nothing to manage because these are basically insurance products. And what's crazy about index annuities to me, and crazy to buy them, is the pitch on them is you get tax deferral, but you also have a situation where you're guaranteed not to have a loss. Well, that sounds great. And then they say the index annuity will also allow you to participate in the market upside. So, hey, who doesn't want that? I'm guaranteed no loss, and if the market goes up, I'm going to participate. What isn't often made clear is that your participation in the upside is capped. And that participation is usually capped at maybe 3%, 4%, something like that. So you've got a guarantee of no loss, but you've got a 3% cap, and you're paying 6, 7, 8, 9% just to get into the thing, plus perhaps a management fee on top of that. It just doesn't make sense. So the other thing is, understand insurance companies are going to make money. So let's say that they have to pay out 3% or 4% a year for several years because the market has been going steadily upwards. Well, they reserve the right to adjust that cap down, and they're going to do that because they're in the business of making money. So something to be aware of. Last product is hedge funds. Most of them want performance fees on the first dollar they make you, plus a management fee whether they make you money or not. So they're really double dipping. I'm not sure that's reasonable. I mean, if you bought a hedge fund through your broker, he or she is most likely also getting a commission for putting you into the fund, plus a trailing fee of around, maybe 0.5% or 1%, and that's on top of the fees that you're already paying that person to help have your money managed. So there's a couple exceptions to this. I'm not really sure they're worth going into, but a hedge fund that has a hurdle, which means your performance fee doesn't kick in until you get 3, 4, 5, 6% or whatever. That sometimes can be a solution that's worthwhile for some accounts. But for the most part, what you're seeing with all these products is that Wall Street is getting richer while you are getting poorer. And here's the solution for you. Here's my solution, at least. Disclose commissions. And in fact, in the United Kingdom, they did just that. They were required to begin disclosing all the commissions. And what happened is financial advisor sales basically dropped around 80–90%. I mean, knowing that you're going to pay 50, 60, 70, $100,000 on your $1 million IRA or your brokerage account to someone that really isn't providing hardly any value at all, that's just picking hedge funds to put you into, it just doesn't make sense. And in fact, there's actually a group of financial professionals in the US that is required to disclose any and all conflicts of interest, as well as they have to disclose any commissions that are paid. So, just to give you an idea how rare this is, according to Cerulli Associates, which is an independent research firm, only about 10% of the financial industry has accepted that trustee type of responsibility to their clients. And if you don't find that a little bit scary, then you probably need to start watching the video again. So, where does that lead us? The inevitable conclusion of all this stuff. Most individual investors have not been successful managing their own money. If you choose to buy and hold and do nothing, you have to be prepared for long periods of time with little to no investment gains, and maybe even periods of time where you are losing out to inflation. Hiring most financial professionals that we've seen has actually hurt significantly more investors and people and families than it's helped. The farther you get away from the Wall Street system, the more of your money you're going to be able to spend on yourself. Lastly, most of these great products, these new things that they say you need to put your money in, variable annuities or mutual funds, hedge funds, non-traded REITs, whatever, they've all got hefty price tags. And those price tags really hurt your results over time. So you're probably thinking, wow, I didn't know about all this stuff. What can I do to start helping myself today? Well, here are some simple tools for you. And don't worry about pulling out your credit card. This is not a sales pitch. There is nothing to buy. So, you can keep your wallet locked up or out in the car or wherever it is. What we can do for you is if you subscribe, you're going to get a set of simple tools that will help you enjoy a better life through smarter investing. And this set of tools is going to teach you things like how to recognize when the environment is good for investing and when it's a good idea to reduce your risk. It's going to help you figure out an objective way to understand if the stock market is actually overvalued and why that matters. And actually, it's not the reason that you're probably thinking. Just because the stock market's overvalued doesn't mean a crash is imminent. There's something else that's important to understand about the value of the stock market. You're also going to get no-cost updates from a nationally cited investment expert, someone that understands the markets, understands the products, someone that manages money on a regular basis, a daily basis for clients. You're going to learn how to tell if your advisor is legally required to put your best interests ahead of his or her own. And again, according to Cerulli Associates, it's about 1 out of 10 that's willing to take that responsibility. Lastly, for the first 50 subscribers today, I will send you a special report. It's called the Bond Bomb, and it's a must-have for investors that are either in or nearing retirement. So that's really it. I hope you've learned something significant today, something important to you, and if you didn't, maybe you should have a look at the video again. Remember, 90% of the financial industry, nearly 90% of the financial industry is commission driven with no obligation to put you first. And again, if that doesn't mean something to you, it certainly should. You deserve better. So subscribe below, get some better tools to help you on your financial journey. In closing, if you've got some questions, feel free to give me an email. I'll do my best to get back to you within 24 hours. And best to you and your families, and good luck.